You walk past these stores every single week. You've bought something from at least half of them. And right now, several of these companies are bleeding cash, while the name on the sign still looks exactly the same as it did 5 years ago. That's the part nobody tells you. A brand doesn't have to disappear overnight to be in trouble. It can keep the lights on, keep running ads, keep opening on time every morning, while the business underneath is quietly falling apart. By the time most people notice, the stock has already lost most of its value. So today we're going through 10 well-known brands, currently showing real financial warning signs, declining sales, mounting debt, store closures, and in some cases, bankruptcy filings. Then we'll flip it around and look at 3 companies with the opposite problem: too much cash, too little debt, and decades of proof they can survive almost anything. By the end, you'll know exactly what to check before you ever put money into a brand just because you recognize the logo. One thing before we start. This isn't a list of these stocks will crash or these stocks will make you rich. Nobody can promise that, and anyone who does is lying to you. This is what's publicly reported: earnings calls, credit ratings, company filings. What you do with that information is up to you. Let's start with the mistake almost every beginner makes: why familiarity is not safety. When most people pick their first stock, they pick a brand they like. They shop there, so they assume it must be doing fine. But loving a store and that store being financially healthy are two completely different things. You can enjoy shopping at a place that is losing money every quarter. The employees are still friendly. The shelves are still stocked. None of that tells you anything about the balance sheet. Here's the actual test that matters. Is the company selling more or less than it did last year? Is it piling on debt to stay open? And can it comfortably pay what it owes? Everything else, the vibe, the nostalgia, the commercials, is noise. So let's put 10 familiar names through that test. Retailers under real pressure. Kohl's. Once one of the most reliable department store chains in the country, Kohl's has spent the last several years watching mall and off-mall foot traffic shrink while shoppers move online or toward discounters. Its earnings have stayed under pressure even as the company has tried multiple turnaround strategies: new store formats, brand partnerships, cost cuts. The core problem hasn't gone away. Fewer people are walking through the door. Bath and Body Works. In early 2026, the company told investors to expect full-year sales to actually shrink, somewhere between 2.5% and 4.5% lower than the year before. That's not a company predicting growth and missing it. That's a company telling you up front that things are going backward. Add to that a departing chief financial officer in the middle of a company-wide transformation plan, and analysts have flagged the situation as worth watching closely, even while the company still generates real cash flow. GameStop. The video game retailer's most recent reported quarter showed net revenue down close to 5% year-over-year, driven by double-digit declines in both hardware and software sales. This is a company that survived one of the strangest chapters in stock market history, but the underlying store business, the actual buying and selling of games and consoles, keeps shrinking. Peloton. At its peak, this was one of the most talked about fitness brands in the country. Since then, the stock has fallen dramatically from its highs, and the company has cycled through rebrands, price changes, and subscription tweaks, trying to find stable footing. None of it has fully convinced the market that the growth story is coming back. Torrid. This plus-size fashion retailer reported a quarter where net sales fell over 10% and comparable sales dropped more than 8%, with the net loss widening. That alone would be concerning. What made it more serious is that a credit rating agency downgraded the company afterward, specifically citing that its debt load doesn't leave enough breathing room to comfortably cover interest payments over the next year. When a rating agency says your capital structure is unsustainable, that's not an opinion, that's a formal warning to lenders and investors. Red Robin. The burger chain has been closing underperforming locations while still posting a net loss in its most recent full year, even after improving from the year before. Rising labor costs, large restaurant footprints that are expensive to maintain, and inconsistent sales at existing locations have all combined to squeeze its financial flexibility. Spirit Airlines. This is the clearest example on the list. Spirit entered bankruptcy proceedings again in 2025, its second trip through that process in a short span of time. Ultra-low-cost airlines operate on razor-thin margins to begin with, and Spirit has struggled to make that model work against larger competitors and rising costs. Leslie's. The pool supply retailer saw its cash position shrink to a fraction of what it used to be, alongside a worsening debt-to-equity ratio. The company later did a reverse stock split, combining 20 existing shares into one, specifically to keep its stock price high enough to stay listed on the Nasdaq. A reverse split doesn't fix the underlying business, it just resets the sticker price. The company itself said it was meant to signal that management was taking the situation seriously. Bloomin' Brands, the parent company of Outback Steakhouse. Even after improving its finances somewhat in 2025, the company closed more than 30 stores that same year, and analysts have flagged that foot traffic is expected to keep falling. Menu changes and price increases at Outback have also drawn criticism for hurting the experience that built the brand's loyal customer base in the first place. Dollar Tree, which owns Family Dollar. Family Dollar has been closing hundreds of stores as its parent company restructures the chain following years of declining sales. When a company sells off or shrinks the very brand it acquired to grow, that tells you the original bet didn't pay off the way they hoped. 10 different industries, 10 different stories, but notice the pattern repeating across almost every single one. Shrinking sales, growing debt relative to what the business can actually support, and physical stores closing because the math no longer works. None of these companies are guaranteed to fail. Some of them may turn things around completely, but right now, the numbers are the numbers, and the numbers are telling a consistent story. So what does the opposite of that story actually look like? What safe actually means in the stock market? Before we get to the three companies, let's be clear about what safe means here, because no stock is risk-free. Every stock can go down. What we're really looking for is financial resilience, a company that generates far more cash than it needs, carries debt it can easily pay off, and has proven, across multiple economic downturns, that its business model doesn't depend on everything going right. Costco. As of its most recent reported quarter, Costco was sitting on over $18 billion in cash and short-term investments. Its long-term debt is under $6 billion, compared to over $32 billion in shareholder equity, meaning the company could pay off its long-term debt several times over using its own equity cushion alone. Membership renewal rates sit near 90%, which means the vast majority of its customer base is essentially guaranteed to keep paying every single year, regardless of what the broader economy is doing. The company recently raised its dividend by over 13%, a move companies generally don't make unless management is confident the cash will keep coming. Johnson & Johnson. This is a company that has raised its dividend every single year for over 60 consecutive years, through multiple recessions, wars, and market crashes. Its gross margin sits above 60%, meaning it keeps a large share of every dollar of revenue after covering the direct cost of making its products, a sign of real pricing power built over decades. The company also holds tens of billions of dollars in cash reserves against its debt, giving it room to keep investing in research, even during a difficult year. Visa. Visa doesn't lend money, and it doesn't take on the risk of unpaid credit card balances. It simply takes a small cut every time a card gets swiped anywhere in the world. That's an extraordinarily capital-light business model, which is why it consistently generates enormous free cash flow relative to how much it actually needs to spend to keep running. Its dividend is smaller than some of the others on this list, but it's grown at a rate of roughly 15% a year, which means the value of what shareholders receive keeps compounding quickly over time. Look at what these three companies have in common. Costco's business barely changes whether the economy is booming or shrinking, because people still need groceries and household basics. Johnson & Johnson sells products people need regardless of their financial situation. And Visa profits from spending itself, not from any one product or trend staying popular. None of them are exciting stories. None of them are going to double overnight. But none of them are one bad quarter away from a credit downgrade either. The actual lesson here. Here's what ties this whole video together. The 10 struggling companies we covered aren't struggling because they're bad brands people stopped liking. Several of them are still popular. The problem is almost always the same: revenue moving in the wrong direction, while debt obligations stay fixed or grow. A company can have loyal customers and still lose money if its costs are structured wrong or if its debt payments eat into cash it needs to actually run the business. Meanwhile, the three companies we just looked at aren't safe because they're boring or old. They're safe because their numbers back it up: cash reserves that dwarf their debt, margins that hold up under pressure, and customer relationships that don't evaporate the moment the economy gets shaky. So the next time you're deciding whether to invest in a brand because you like it, ask yourself the same three questions we used here. Is revenue growing or shrinking? Is debt manageable relative to what the company actually earns? And has this business proven it can survive a downturn before, or is this the first real test it's ever faced? Those three questions will tell you more about a stock's future than any logo, any commercial, or any story about how long you've shopped there. None of this is financial advice. It's a starting point for your own research, not a substitute for it. But if you walk away from this video checking those three numbers before you buy anything, you're already ahead of most people who invest based on nothing more than brand loyalty.